So what I'm going to be sharing with you over the next few minutes is a whole bunch of data and insights from the 45,000 customers that we have globally that run their equity through Carta. I'll share this again at the end. People tend to want to connect to me after I've shared the data rather than before, so we can have that quid pro quo. I also have to just quickly say, I'm not a lawyer. It's a disclaimer. We can skip this part too. Let's jump right into the reason why we're here today. So the state of private markets, we've been collecting data on this since around 2018. So everything from the back end of 2018 up into the present day. I'm going to start by giving like a holistic overview of what we're seeing and kind of breaking it down on a quarterly basis as well. So some might say last year was a bit of a mixed bag. There were definitely some positives. If we look that despite the fact the number of rounds in terms of quantity went down, in terms of venture capital being injected, there was actually a nearly 20% increase in the actual capital that was being given to the startup ecosystem last year. So that's obviously very, very noteworthy and a positive trend that we are seeing. If we then break this down quarter by quarter, and this obviously then includes pre, during, and post the pandemic bull run, we can actually see from what we've observed for the last 2 years that the stability and the reset of the market is definitely now taking shape as the numbers are more akin to those before the bull run, with around 1,300 to 1,700 deals being done per quarter, and roughly about $20 billion plus each quarter being invested as well. But something to take note for startups and investors in the room today, it's actually getting harder and harder to get from one stage to the next. If we look at some of the data points from a couple of years back, it could take just over a year to get from C to A to B, and so forth. However, what we're now seeing is an average of around 2 years to get there. Now, if you are a seed stage company, for example, that means the cash that you are receiving has to last you just as long as it would from going from A to B. And as we know, the investment rounds aren't as large, so you've got to make less go further. Specific to fintech, we are seeing bridging rounds in fintech, kind of bucking the trend in terms of the averages. They're still pretty common in early stages, with around 50% at the seed and Series A stage actually being bridge rounds. Now, that might be okay in terms of the bridge side of things on the seeds, on like seed rounds. However, A+ across the wider industries are actually on the decline, with just the seed rounds actually being quite prevalent when it comes to bridging funding. I've tried putting a narrative of making this positive in terms of down rounds. The slightly good news is that they are decreasing ever so slightly. This is, of course, a reflection of the fact that there was, I guess now in hindsight, overvaluations of companies during the pandemic bull run. So we're now starting to see around 1/5 of all rounds, down rounds currently. But we're hoping this is going to plateau and then start to actually dip over the months and years to come. I promise I have some better news later, but I have to share a bit of kind of tough news to begin with. It's getting tougher and tougher to get from C to Series A, which of course is the kind of really essential kind of part of the journey of a startup, right? Kind of graduating from C to Series A. If you'd got your funding 3, 4, 5 years back, around 30 to 35% of those companies would graduate from C to Series A within the space of 2 years. This is now halved, effectively. So companies that receive their funding during the back end of 2022, going into 2023, we're actually seeing only about less than 1/5 of those companies now graduating. Just to rub a little bit of salt in the wound, and I promise I have some better news after this, we're not seeing anything that's indicative of that trend kind of turning around anytime soon. We hope that over time that does start to turn around, but there's nothing right now to suggest that it will in the immediate future. So what does this mean for private companies and private markets? It means companies are staying private longer. The market conditions haven't been very conducive of IPOs or exits recently. And this is really seen if you look here with the Series D on the top right-hand corner. It used to take about 6.5 years to go from incorporation to Series D. Now it's nearly 9 years, and some companies actually pushing the 10-year mark. to go from incorporation to those later stages of fundraising. As promised, I have some good news as well. So even though there are some challenges with the earlier stage companies right now in terms of the funding ecosystem, we're still seeing a lot of activity and increased activity at the later stages too. In fact, even if you look at Series E+, so very late stage companies, because those companies are not going public, because those companies are not exiting because of those market conditions, they still need capital. And as a result, we're seeing a lot higher activity in those upper ends of the market. Bringing it back to fintech, you could label fintech as being a bit of a steady eddy over the last couple of years. It's really kind of stabilized after that bull run. We could see there were some quarters where there was over $7 billion worth of investment per quarter. That's now back to kind of normalization around the 1.2 to 1.5 billion mark, and it's been that way for the last 2 years consistently. So we're hoping that's, again, a foundation to build upon for fintech. Other good news for fintech companies as well, if you're looking at that Series A stage specifically, we saw at the back end of last year a 2-year high in valuations for fintech companies. So again, there was a bit of inflation during the bull run, but however now, we're going back up to around the $50 million mark in terms of the average valuation of a Series A fintech company. I mentioned earlier that there's been less rounds, but more capital injected, which is one piece of good news. The other piece of good news is that valuations are going up too. So despite the fact there's a lesser quantity of deals being done, the valuations that are being demanded and actually accepted by investors from founders are actually higher. There is a slight caveat. Series D decided to go rogue and actually go down by a few percentage points. However, broadly speaking, valuations are on the up. Also, if you are a founder, your dilution is actually getting better as well. You're actually giving away less of your equity as you are raising capital right now. So this does tend to lead to a question. Okay, so Charlie, if there are less rounds, how comes founders are able to actually demand more in terms of valuation and get better terms? Bombshell, AI, right? It's obviously a very, very prominent industry right now in terms of the investment scene. And what we're seeing here is in this red circle you can see behind me, this right in the top right-hand corner, the amount of investment in the billions, of course, and also the valuations and the average investment amount is actually quite substantial, really pushing it up to that top right-hand corner. This is also reflected with C-stage AI companies. Since we actually carved out the AI sector, we can actually see that the valuations are increasing, leaving non-AI companies with quite a big delta to catch up with. Now, just to wrap up a few more things on an optimistic note as well. We're estimating that the total amount of venture capital that was invested last year is kind of pushing towards the $85+ billion mark. We're just finalizing those numbers over the next few weeks. But also our forecasts and predictions tell us that there should be an increase again this year in venture capital, meaning more investment in the global startup ecosystem. I made reference earlier to the fact that companies had been staying private for longer because of the market conditions, and exiting, mergers and acquisitions had been slow. But again, the data is showing us that towards the back end of 2024, we're starting to see an increase once again in M&A, meaning there's more potential for investors to make their money back, for startups and for the employees that work for them to actually realize some liquidity as well in the options that they have. Now, if you'd like to continue learning with us, please feel free to scan this code. This will take you to our Founders Ownership Report. We have a whole host of reports on our websites with tens of thousands of data points, so please make the most of this. And if you'd like to connect with me, and I can share some insights that we have for Asia Pacific as well, and more global data points, feel free to do so. I'll be happy to share those and speak with you guys later during today's proceedings. Otherwise, thank you very much for having me. I hope this was insightful, and enjoy the rest of your day. Thank you.